Hi, it's Michael Kerr here, presenting Small Business Banter. A healthy micro and small business sector means a successful economy and a more vibrant society. Small Business Banter is about helping regional business owners better prepare for current challenges, but also for the next stage of business success. I'm Michael Kerr, founder of Kerr Capital, advisors to business owners. Each week, I interview a fellow small business owner or an expert, and they share their stories, their lived experiences, the wins and the losses, and their best advice to help you, the listener, get the most you can from your own business. Small Business Banter is brought to you from the studios of 104.7 Gippsland FM and is heard across Australia on the Community Radio Network. And thanks also to Kerr Capital, supporters of the show. Okay, so welcome to another edition of Small Business Banter Radio. Lovely to have in Mike Williams on today's episode. Mike is the CEO of Exit Value Advisors, and we're going to be talking about how to value a small business. And I'm pretty sure that's going to be front and center for a lot of the small business owners listening in. So firstly, welcome in, Mike.
Thank you. Good to be here.
Yeah, it's great to have you on. Mike, from your profile, I've known you for many, many years, but and the work you do, but you've, CEO of Exit Value Advisors, you fundamentally help business owners to understand the value of their business, what drives the value of their business. Over the many, many years you've been doing this, you've completed thousands of them. But you just, I think if I was to boil down your philosophy is information is power for you, if you know what your business is worth, not just when you're selling, but along the way, that would be quite powerful. So do you want to just give us a little bit about your background and why you're in business valuations, and we'll get to then talk about, how we're going to encourage people to dig deeper and understand more about, the value of their business and what drives it.
Yeah, sure. Look, I'm different to your typical valuer, which we'll probably get to later. So I started out life out in the manufacturing industry with a training in chemistry and computing, and I spent a lot of time working in big business, and then eventually wanted to start my own career doing my own thing. Got out into consulting after I finished an MBA, and was helping business owners grow their business, and that was all about business planning. And I sort of fell into valuation because some clients asked me a question: "What's my business worth? Someone's offered me this. Should I take it?" And I've always wanted to be able to help people out and help them make decisions. And so I worked through what I knew about valuation from my MBA degree, and all of a sudden I saw a light go on over the top of their heads. I thought, oh, right, okay, it's not worth what I thought it was. We better do a business plan. And it was a bit of a moment for me, because I all of a sudden realised that valuation was actually a tool to help people make decisions. And after I spent some time working with a broker in Gippsland and learning a lot more about valuation and sort of working with a few other people in the field, I started to do it myself and sort of evolved into working with small business owners.
Yeah. So if it seems like there was a prompt there. Someone's come along and wanted to, buy someone's business. So they go, well, what is it? That was a bit of a light bulb moment for you as well as for the owners. Is that typically what, in your experience, drives owners to want to understand it, or are there other trigger events that typically or often happen?
I often talk to people about discretionary reasons to do a valuation and non-discretionary.
Okay, yeah.
The non-discretionary, and we'll probably get into this later, is when the lawyer or the accountant tells you go get a valuation. But then
which is what sometimes for tax planning or for,
that's right,
that sort of stuff.
Yeah, so they could be restructuring their business. There's a need for the ATO to have valuation. They could be in a dispute. There's a number of those different reasons, raising finance, all those sorts of things, or just plain selling their business. That's an obvious one. But what I did find is that there were business owners who intuitively thought, "How well am I doing?" And I think a lot of business owners answer that question at a very high level, at a surface level, and there's only a few of them that really dig below the surface and say, "Well, how do I know that I'm doing well? I'm not just comparing myself to others." So it's sort of an evolution.
Yeah, and looking beyond how much cash is in the bank or those sort of day-to-day measures of how well am I doing in a business, which I think, a lot of owners maybe use that as a proxy for how well the business is going. You keep going, Mike.
No, I was just going to say, I often say that valuation is one of the few areas in business where you combine the profitability of the business with the balance sheet of the business and some measure of risk. And it's a way of pulling those three concepts together.
Okay. Yeah. And we will dig into some of the common methods and try to explain them in everyday language. But you started on the non-discretionary, so valuations. Just explain that a little bit more. This is reasons why, and it probably came out of your consulting work or somewhat influenced by your consulting work. There are other good reasons to get a regular valuation of your business.
Yes. The broad one is when someone either wants to sell or they get an offer. Someone says, "I'll offer you $1 million for your business," or whatever that number is. And the very first question that goes on in the owner's heads is that enough, or can it be more? The other reasons can range from a wide variety. So it can be I'm bringing in a new owner or a new partner. So they want to effectively sell part of the business to either an employee or someone else, an investor. I mentioned already the raising finance. Banks don't really look for valuations anymore. They used to. They do in some circumstances, but it's rare. But when I talk about raising finance, it's really getting investors into the business.
Okay, yeah. The banks are pretty much, for small micro business, look at the other assets outside of the business, don't they? Yeah. So if you wanted to, just so we kind of get the basics out there, if you were to describe what a valuation comprises, for me, it's maybe two things. It's what is a level of earnings after everybody else has been paid. So that's surplus profit, surplus cash, it could be different. And also if you are selling, typically buyers will look at paying a multiple. So that is if a business can make $100,000 of profit consistently, when you hear the term multiple, what you're talking about is how many years of profits a buyer, how many times 100,000 that buyer is willing to fork out upfront.
That's right.
Is that so? That we talk about it from that point of view: earnings and a multiple or a number of years of profits that someone's prepared to pay.
Yes, that's one method, and it's often the common method of valuing a business. I step back from that often and ask the question: Is the business commercially viable at the moment? And by commercially viable, I mean, does it generate sufficient profit or cash flow to pay the owner a market wage? Are all of the other transactions that are going on in the business at arm's length? And is there rent being paid on an office or a facility at market rates and all those sorts of things. So if there's still profit left over that's at a reasonable margin, then I say it's commercially viable. And then we use the multiple method for valuing the business as one option. A good mentor of mine that once said that valuation is all about your P's and Q's. So profit is the Q, which is the quantity, and the multiple is the equivalent to price, which is the P. So your value is price times quantity. And in essence, it's a simplistic way of looking at things, but it makes some assumptions. And those assumptions are that the risk profile stays the same over a period of time. It assumes that the business has reached a certain level of maturity, and that earnings are going to keep going the way that you expect them to. So there's a lot of things in that can catch up someone and say, well, okay, that's not really going to happen that way. I'm not prepared to pay that sort of money.
Yeah. So it's when you, this idea of a commercial or a market wage for the owner is a big factor, right? Because when you have a small business, you can run a whole lot of things through the business financials, and that's okay. Your private expenses and, all within it happens all the time. But one of the things that often gets missed is, the owner will draw out money or pay themselves an unrealistically high or low. So the true measure or a true measure is, if you had to pay somebody else to do what the owner does, that's where that market rate comes from. Is that right?
That's right. Yes. Yeah. What would you have to do to replace you?
Then the business as a standalone thing is paying the owner who works most of the time, works in the business. They're getting what, is a market wage. So any profits over and above that are true, it's a true return, a true profit. How many owners, I do want to draw out this idea that we shouldn't just get a valuation only when we're forced to or need to. You talk a lot about getting a valuation along the way and some of the benefits that might come from that. Do you want to talk a little bit more about that, Mike? And by the way, on today's episode of Small Business Banter Radio, we've got Mike Williams, who's the CEO of Exit Value Advisors.
Yes. So we've talked briefly about the P's and Q's, the multiple and the earnings. So the question becomes, well, what is my earnings going to do over the next 2, 3, or 4 years? And often that's a bit of an unknown question. But you can reason your way through a process to say, okay, this is how much profit we're going to make. We're going to allow for working capital. We're going to allow for market wage and all that stuff. But then the question becomes, well, how attractive is the business? What's the risk profile? And that's the one that often people struggle to say, well, how do I work that out? And that's that multiple number as one way of thinking about it. And so what we do is we look at that multiple from two aspects. The first thing we say is what's the very worst multiple that would be paid for a business like this? So it could be 1 times earnings, or it could be 0 times earnings, but that's not often, or it could be 4 or 5 or whatever that broad range is.
And is that maybe a typical range? Like if you're not familiar with valuations, if you put it somewhere between 0 and 5,
Yeah.
would that? I mean, it's a massive range, I know, but
Yeah.
does that help? That puts in the frame for someone listening who's really got zero idea.
Yeah.
That if your starting point might be somewhere between 0 in extreme, but say 1 and 5.
Yeah, and that would be about right. 5 would be, for most small businesses, it will be very extreme, but it's not unheard of. And 1 times is probably more often common than you think.
Sorry, what would, like a 5 multiple, what would be the characteristics of a 5 multiple business?
Yep.
Say against a 1 multiple, like the really, the most critical factors that would drive it up or down to those extremes.
Okay, so there's 4 or 5 things that we typically see associated with very highly valuable businesses. The first one, unfortunately, is size. So size, revenue, right. The size of the revenue has a big impact on multiple. In essence, it should really be the size of your profit, but anyway, the two are related. and also the profit margin. So those two are fairly key. So it's likely to have a revenue level more than 4 or 5 million. It's likely to have profit margins much higher than industry standards, industry expectations. So it could be 10% on the low end, or it could be 25 or 30%.
Right. Yep.
But then there's some other things that we look for, and in really broad terms, we look for documentation and systems so that the business can operate without the owner.
That's the E-myth kind of stuff, that the more the business can operate without the current owner in the business,
yes,
the more robust, the more proven, the less risky it is. Yeah.
Yeah. So do they have a staff structure? Are those staff trained in different roles? Is there a number of people that look after key areas such as financial management or client or customer management? So they're the sort of things we go looking for. There's also one other thing, and that's a competitive advantage. The really highly valuable businesses will be able to articulate a real key vision and mission, and they'll be able to say why customers or clients buy off them. And sometimes it may be very simple, but they can present it really well and communicate it clearly. And that's when you sit back and think.
So, Mike, what you're saying there is, the value of getting that regular perspective through a valuation on your business is quite powerful, because it really can give you that external perspective that we were just getting to, that somebody else looks at your business with a different set of eyes and can see things differently. And I think, one of the challenges of being in small business is you work hard and, you run your business, but there are things that you can do differently and things you can change, but, often it comes from a third party having a look at it and sort of, getting an idea of the value of your business just for the purpose of understanding what it is or isn't, and what changes it and drives it is one of the really powerful things, and something you're advocating for through that non-discretionary valuation.
Yes. Yeah. The interesting thing that we often find is that when people get a valuation and they say, "Well, what makes this multiple up?" we can often start to say, "Well, if you did these sorts of things, more regular reporting, more detailed systems, less reliance on key people, then the multiple will shift up by a certain amount." And we can equate that to an increase in value. And that tends to give people more motivation to say, okay, I can work on those sorts of things. It's more concrete.
Plus the upside along the way, right? So even if you're many, many years out from selling or doing something, like exiting, you've got to keep, well, you don't have to, but, you'd like to think that there's opportunities to improve the profit and what you can take from the business along the way, which is,
yes.
That comes again from, doing what you do day to day, but also understanding the different things that drive the value of your business, that can make it more profitable, that can deliver, less risk, or give the owner more freedom in terms of hours. That's a simple but really powerful objective.
Yes.
So in terms of maybe just some common mistakes you see in valuations, I want to talk about this just because, valuations are very subjective. They're opinions of value. So what are the really doozies of errors or mistakes that you see or have seen?
Look, I divide them into two classes, and it really is important to emphasise a valuation is nothing more than a well laid out opinion. So there
it's not. It's certainly not gospel, is it?
No, it's not gospel. But the sorts of things that I've found is I've often found people assuming, for instance, I don't need to add back the wage. The other thing that they find that I often get is that they'll give me draft financial reports, and they haven't been vetted by an accountant, and there's certain adjustments that haven't been made. And when you compare them with history, all of a sudden it's chalk and cheese. So
that could be simply because the management accounts have some personal expenses, or in fact, or maybe don't have some of the expenses already in them yet that should be there.
That's right. Yes, that's exactly right.
Yeah.
And it's also difficult to compare management accounts with past accountant reports, because often that the accountant reports are done for tax reasons. So it's not always a straight off comparison.
And that's I think that's a really important point to make, Mike. That the typical financials are required to be prepared every year, fundamentally for the reason of complying with your tax obligations. And so the incentives are to drive down profit, to decrease the amount of tax payable. And there's nothing wrong with that, but it doesn't, the bottom line there is often not reflective of the real return or profit or surplus in a business. And that's the process you talk about of making all those adjustments. And I think owners shouldn't be scared about going through that process for that reason. It's normal that, you've got to reconcile or adjust what your tax figures are for, for the reason of valuing your business.
That's right. Yes. Yeah.
So let's, is there any way that an owner could easily access some quality information about what potentially their business might be worth, just to kind of fuel the fire a bit, or just to get them started on thinking about it? Is there some places that they could go, or is it? Yeah, you're the expert on this. Put you on the spot here.
So there used to be a regular report of small business transactions that you could buy a report and for a few $100s, and it would give you the multiples for different industries, for different businesses. Unfortunately, that's no longer available. There are some private, more privately sourced materials, such as the Australian Institute of Business Brokers, but to access that, you need to be a member.
Yeah, or you access it through a member, maybe if you.
That's right. Yeah. What I often say to people is, look, approach this with a big degree of caution, but do a Google search, businesses for sale in your particular industry, like cafe businesses for sale. And you'll get a lot of rubbish that will come up. But you will also identify a really broad price range and you'll look at the different characteristics of the business, and you'll be able to get a feel for, well, okay, this is what they're asking. Now, obviously, businesses are advertised always higher than they will sell.
Yep.
So you need to discount that number, but it's a really good starting point. It's a good way of saying, is my business worth cattle stations, or is it just worth rats and mice?
Yeah, and I guess that's the thing. It's with caution, but it's the start of, if you are intrigued, and I haven't met a business owner that isn't, intrigued about the potential value of their business. And there's a few topics we're not going to get to, unfortunately, but looking at that information that is available will maybe highlight the fact that the range of potential values is so extreme that you really need to perhaps get some better quality advice, which is not a bad thing, because as you said, they are statements of opinions and all laid out, but there are better quality valuations. And we don't want somebody kind of getting carried away with the fact that they saw a really high price business, or someone told them that a friend of theirs had sold for a really high price. It's a common trap. In terms of just the last minute or so, Mike, what are your parting advice for owners listening in to encourage them to get this non-discretionary valuation, and we're not trying to plug you or any particular value, but what we are trying to do is instill this idea that if you're building your business, there are probably ways to make it more valuable for whenever you decide down the line to make it, put it on the market. What's your parting advice on that?
So my parting advice is to always get another opinion other than your own. And the reason I say that is because you're going to make some decisions, and you need to have some information that you base those decisions on. Am I going to sell at this price? Do I just walk away? Could this business be worth more if it was more profitable? And so unless you have reliable information to make those decisions, then that decision is really going to be potluck in the future. So it's really getting a second opinion to say, this is what someone else thinks.
A second opinion from somebody that does, have a current understanding of the way businesses are valued. I'd probably add to that.
Yes, that's right. Yeah.
Hey, Mike, we're going to have to cut this one off. Thank you for your time today.
That's okay.
Look, it's a highly topical discussion, and maybe we'll think about doing this again another time, because there's a lot of mechanical but important mechanical stuff we could get to. Mike Williams from Exit Value Advisors, thank you very much.
No problem. Thank you.
So that is all for today's episode of Small Business Banter. I continue to be inspired bringing you small business experts and other small business owners and hearing their stories. If you want to listen to any past episode, jump onto your podcast platform of choice and search Small Business Banter. There you will find a diverse and fascinating collection of small business owners and experts openly discussing and sharing their experiences. For any of the links, resources, or information we've talked about on the show today, or to contact me, please head over to smallbusinessbanter.com, or you can find us on Facebook and Instagram. And it would be great to have you tune in the same time next week for another episode of Small Business Banter.